Hi everyone, it's Patrick from Patrick Henry. Following up from last week's video, decided to talk to you all about buy-to-let investment. I've had a lot of questions come through, a lot of people asking me exactly how to do it, what the best processes are, the best practices are. And I'm going to try and navigate through what is essentially a bit of a minefield because it's a very complicated subject, as all investments are. Some people don't pay much attention, some people go in head first, and other people take their time, try and learn as much as possible about the market and about what they're going to invest their money in, how they're going to invest it. So the first thing that I'm going to talk to you about is why you're actually making the investment. Some people make an investment because they believe in the long-term growth of the property market, in having sustainable returns from their investment, and just because if you look back in history from the 1980s to where we are now, you see a huge growth in property values, and a lot of people think that trend will continue. I'm a little bit more skeptical, certainly not at the same rate that we've seen, especially in London and the big cities like Manchester. I don't believe that sort of trend will return, and if it does, I expect it to be a bit more tempered than it had been for the past 30 odd years. So really think to yourselves, what do you want from this property investment? Some people buy properties with a fantastic yield, which means the money that they put down generates quite a lot of money a month for them. A lot of people see stocks as not returning a lot of money on a monthly and annual basis, and so they believe that property investment will actually give them that, and that can be true. Depending on where you buy in the country, you can receive upwards of 10% returns, gross returns, but that isn't true across the country, and it's certainly not true in the big cities. London, there's a whole range of different situations in London depending on where you buy. It's not as simple as saying you buy in London, you get this sort of return. So thinking about what you want, do you want long-term growth? Do you want money on a monthly basis? Do you want a mixture of the two? Do you want to expand a portfolio so that you can leverage your deposits that you put down so that you can buy more properties, maybe from investing in the properties? There are all sorts of different tactics. A lot of people buy a property and just think that's my pension fund. In about 30 years time, the mortgage is going to be paid off, I'm going to have money coming in on a monthly basis. That's an absolutely legitimate way of looking at it. Bricks and mortar is very easy to understand for people. Unlike stocks and shares and bonds, which can be seen as a bit confusing maybe because it's not something that you deal with on a daily basis. And a lot of people don't want to deal with private investors or investment companies to take care of their finances. Maybe the fees are seen as a little bit expensive, or they're not 100% sure after the financial industry's had a few interesting years over the past 10-12 years. Regardless, it's really important to think why you're buying a property. It's not a land of milk and honey. There are many pitfalls, and I'm going to try and cover some of them off here. So something to think about is how much you want to spend, what sort of returns you want back from that, and when you want the returns. Because depending on how much you want to spend and depending on how much time you can spend on the investment, really depends on what you buy and when you buy it. For example, if you live in London, you're making a large amount of money a month and you want to buy a property just because you see it as a good long-term investment. You may think that buying up in the northeast, for example, where my dad lives, is a great idea because you can get yields of 10% plus. That's great, and you could buy a property for maybe £100,000 and receive a really good return on it. The only problem with that sort of scenario is if something goes wrong in the property, it really does take a chunk out of your money that you've put down. So you may gross a lot of money, but the net return could be quite weak. Also, you may have a different sort of tenant in the property. You may have a tenant that won't stay for very long, or someone that may have difficulties paying the rent. And even a situation where you have a large void period. Void periods are extremely important to think about because they directly affect your returns. For example, if a tenant moves out where we are in Clapham, the chances are we're going to find a tenant to move in literally the day afterwards. So the landlord doesn't actually have a shortage of rent and there's no gap between the two tenancies. That's really important when you're dealing with highly leveraged properties where there's a large mortgage in place, or where maybe you're not earning money that can cover these gaps. It's very important to think about who you're letting the property to, what gaps you might be talking about, because the mortgage payments keep on coming. They're not going to stop. The bank's not going to say, okay, we'll give you a month or two to catch up on things. They're going to want their money. So you need to make sure that you have it. And if you don't have it, it won't take long until you're being repossessed. So be very careful. Think that through thoroughly. A lot of people decide to buy properties and spend a bit of time on investing in the property as well. So they'll buy a property that's got some potential to grow into a more expensive property by maybe putting in new kitchens, bathrooms, extensions, whatever else. This can be a very clever way of leveraging your money. So for example, you buy a £100,000 property, spend 20,000 on it, and all of a sudden it's worth 150. When you come to remortgage the property, you can release more money, which means you can go again quite quickly. That used to be a really good way of doing things. People do that quite often, buy a property, spend some money, invest in it, it raises in capital value. So when they come to remortgage a couple of years' time, they have a deposit for another property. That was great then because you'd get relief on your mortgage. So all your mortgage repayments that you'd have, you could offset against the rent that you'd receive in. However, nowadays, the government is dropping that to zero. So all of the rent, mortgage payments that you make, you can't claim back against the rent you've received. It is currently at 25%, and next year it'll be at 0%, which means that having a highly leveraged property where there's a lot of a mortgage on it doesn't mean you're going to get any relief from the tax man, which is probably absolutely fair, although it is a shock to the system. So people used to buy a property, invest in it, do it up, get the money out of the property and go again. That was great when you didn't have to think about the extra stamp duty that you have to pay. So now, if you buy a second home and it's not your primary residence, you have to pay the stamp duty plus an additional 3%. That's 3 additional percent for buying a second property or a third property, fourth property, whatever it is. So that eats into your margin straight away. So if you're buying a property to invest in and spend money in and improve its capital worth, net worth, then you need to be thinking about that extra 3% on stamp duty that you need up front. There's no delaying it. Well, you can delay it by 28 days of completion, I believe, but there's no delaying that 3%. It needs to get paid. So that's going to eat into your margin straight away. And so we're seeing a lot of people edge away from buy-to-let investing at the moment. In fact, in Clapham, we're getting a lot of landlords that have owned their properties for 20, 30 odd years thinking of selling their properties. They get no mortgage relief. They're not getting the rents that they were getting before. So the margins are starting to get squeezed a little bit. So have a think about that. If you're going to be buying multiple properties, you're going to have to pay this extra stamp duty and you're not getting that rent relief. So do have a think before you buy the property. Are you going to get the returns that you think that you're going to get? If you listen to your parents, grandparents, they'll tell a completely different story of how you should be investing and what they did to make however much money they made. Times change, laws change, tax rules change, and also the outlook of the property market in the future has changed and will change with every day, minute that passes and every new law. So having a think about that is one thing. The next I would look at is what sort of property you're going to buy. Different properties have different costs associated with them. Different properties are suitable for different markets. For example, if you're buying in Clapham, where I am right now, buying a 2-bedroom property is a really bad idea. We have a huge amount of 2-bedroom properties on the market, which means that you have a supply and demand issue. We've got an oversupply and a lack of demand. So prices come down a little bit. You really have to be in the top 10, 15 percentile of properties on the market, quality-wise, location-wise, etc., to find a tenant almost straight away and to be in a situation where you don't have to worry about a void period. So right now I'm getting a lot of landlords investing in their property to bring the level of the property up, the standard up, so they're in high demand. Those properties that are in a lesser condition are really struggling at the moment. And that is something that is completely down to the amount of properties that we have on of that sort in the market right now. 3-bedroom properties, 4-bedroom properties are letting like hotcakes, for want of a better word. So properties are going very, very quickly if they're 3 bedrooms or 4 bedrooms. 5 bedrooms are like gold dust because then you take HMOs into account. That's house of multiple occupancy. So if you've got a property with 5 individuals in that aren't related, then you need to have an HMO license regardless of the type of property. This means you need fire doors, maybe fire extinguishers, exit signs, etc., and a license from the council. So it's very important to think about what property you're buying in what location. If someone said to me right now, what sort of property should I buy in and around this area, I would say get a 3-bedroom property. You'll always have tenants, it will always be let out. The caliber of tenants will be relatively high because the properties are in short supply, which means demand is intense at the moment. 3-bedroom properties don't last longer than a week on the market around here as long as they're priced sensibly. So it's very important that when you're going to look in different areas, you look at the market that's around. For example, you may be in Winchester, and in Winchester it's much more of a family market, so buying a 3-bedroom flat may not be as suitable there as it would be in Clapham, for example. At the same time, houses may be more appropriate in certain locations. Local schools may affect what sort of rental properties you should be looking to invest in, and also the work that goes on around that location. For example, if you're in a commuter belt, then you may be looking at nice apartments. Nice apartments, unfortunately, come with large service charges. Large service charges can really eat into your yields. If you have a house, you have to think about the general upkeep of the building plus the building insurance. If you have a luxury apartment, you may pay a service charge as well, which includes cleaning of communal areas, maybe a concierge, underground parking, a swimming pool, a cinema. I've seen all sorts. And this can make the service charge go from what would be nothing if it's a house, just a general upkeep of the building, to thousands, sometimes tens of thousands of pounds. It's really, really important because that will eat away at your yield. And if you are not of the opinion that the property is going to be going up in value rapidly, then there's no real upside. So a lot of people buy properties for a lot of different reasons. I tend to think about the location I'm buying in. Is there going to be growth in the future? Or am I just buying it for the rental yield? And then I make a decision from there. Then I look at the tenants that are in the area and the property that I'm hoping to get to suit them. So don't just think with your own self-interest, I would love to live in this property. That's great, but you're not going to be living in this property. It's an investment. You know, I would invest in McDonald's because it's a good investment deal, but I'm not going to eat there unless it's been a long day. So make sure you have your investor hat on and you think about the sort of people that you're going to have living in your property. Are you going to be happy with those people living there? Are you happy with the situations surrounding it? Talking to estate agents is very important. I know I keep on saying it, and I know you probably don't like estate agents because of how much misinformation they can give, whether it's intentionally or unintentionally, and how uninformed they can be. If you find a good estate agent, someone with experience, maybe someone that works closely with a lettings agent in their office, or someone that has a good knowledge of the rentals market as well, that can be invaluable. And having someone that you can befriend, someone that you get close to that can give you advice it's like gold dust. They're very hard to find, but when you do find them, they can be extremely valuable to you. So I hope that gives you a good idea. I've got some questions here which have stopped me from rambling on even further. And hopefully these will help you to answer some of the more specific points of buying a property. So Anna's asked some interesting questions. First of all, can you get a mortgage when you already have one? So banks look unfavorably on people for buy-to-let mortgages if they don't already own a property. So if this is your first purchase, the chances of you being able to get a buy-to-let mortgage is extremely low because they like to think of people buying their first home and then buying an investment. They don't like to think of their loan as an investment loan. Sounds bizarre because you should just look at it as a case-by-case basis. Is this property worth the money? Is this person good for the money? Would they be able to pay the loan back? But that's just the way it is. Your mortgage deposit will be a lot higher for a buy-to-let mortgage than it will be for residential. You can put down 5 or 10% deposits for residential mortgages. In buy-to-let mortgages, you're looking northwards of 20%. So keep that in mind because that's another chunk of money that you're going to have to put towards the investment. How do you choose a location based on how lucrative it could be? Assuming you can't afford to buy it in Chelsea, of course. And how do you look at that area for future potential? So I'm a massive advocate for buying in areas that have potential rather than safer areas that have already come and gone. For example, in Clapham, there may not be that much more growth around here. I don't see a hell of a lot more infrastructure coming in. I can't really see where we'd fit another train station or a shopping centre or a large derelict estate being knocked down and built into luxury apartments. I think that's pretty much already happened around here. Although places in Streatham, I can see it happening, Deptford, areas that have really good commuter links or really good potential commuter links, but haven't had the investment pumped into them yet. Typical example is what's happened in Croydon. Fantastic commuter links into London, like out of this world. However, it didn't have the investment put into it yet. Then all of a sudden, Boris Johnson at the time managed to get a huge investment into the area. Westfield's invested in the area. Huge amount of apartments went up and the property market shot through the roof. If you bought a buy-to-let investment maybe 8 years ago in Croydon, you could expect to see a 50% increase on your investment back then. And obviously if you've got a mortgage on that property, so for example you put down a 50% mortgage and the property went up by 50%, then that's a 100% return on your investment minus costs and everything. So that's really important to think about. You only put down a small percentage and receive back a large percentage. That's why traditionally a lot of people invested in property for that key reason. So really, Anna, I would say look at the location you're buying in, not based on what it is now, but the potential of it. A lot of people 15 years ago would not have bought in Brixton because they probably still remember the Brixton riots and thought that's what it's always going to be like. And if you go there now, it's a different place. I get confused when I go there, and I spent a lot of time there when I was growing up. So yeah, but never, ever, ever assume an area is going to remain the same. Things change, property prices go up. Look at what it could be, not what it is. Of course, you've got to be secure in when you're buying the property. So if it's an area where you think you're not going to get the rental returns, you can have large void periods, it's going to put your investment in jeopardy for that time being, regardless of the future, I wouldn't look there. It's too much of a risk. You're probably putting too much money up to warrant not being able to find tenants that will pay your rent. And if you go into mortgage arrears and you lose your property, it's probably a huge amount of money that you will not see again. So that's my advice on that. Then Dean, who is in the financial industry, has asked me some more complicated questions. So bear with me on this one, guys. Okay, so what is the net yield in London? That is not a question that you can answer because it's so varied. There's net yield as well, so it's after costs. Net yield in central London, you can get 1%. If you're buying a house in London, as in Mayfair, or anywhere around Hyde Park, for example, your net yield is likely to be tiny. People don't buy in central London because they're expecting great rental yields. People are buying in central London because it's a safe place to put their money. As Dean knows very well, when you're very, very, very wealthy, it's not so much how you can make money on your money, but how can you preserve your money? And that's what a lot of people do. That's why we've got so many properties in central London where nobody's living in them, because these super duper rich people want to have a safe place to keep their money. The UK has fantastic laws in place, very old laws, very safe laws that mean if you invest in property over here, your money will be safe. So net yields anywhere from the 1% of central London to zones 4, let's say zones 4 and 5, where you might be able to get close to 5%. If you buy an ex-local authority property, or you buy a property above a shop, for example, or maybe on a very busy road, you can increase those yields. But then you have to look at the capital growth of those investments. So properties in council estates don't tend to rise in proportion with the Victorian mid-terrace properties that are in high demand. Same with properties above shops and on busy roads. What's the historical picture? RE vacant period. So that's talking about void periods. Again, it depends where you are, depends on the property. if you've got a 3-bedroom property around here, 1-bedroom property, 4-bedroom property, and it's in reasonable order at a reasonable price, you're not going to have a void period around here. But if you have a 2-bedroom property that needs work doing to it, you may fall into a position where you have a couple of weeks, maybe a month without a tenant. That is completely sensitive to the location where you are. Again, central London, people can have months without a property being occupied. If you've got a luxury house in the home counties, chances are it's only going to be occupied for a few years and then might be empty for 6 months because it's a very specific tenant that you're looking for. But if you're buying in commuter belts and if you're buying in quite transient areas where people move to for work or for the convenience of work, chances are you're not going to fall into large void periods as long as you're being sensible. Is the property in reasonable condition? Is it priced reasonably? If you can say yes to those questions and you've got a decent estate agent, I wouldn't worry about void periods necessarily. What's attractive about investing in something that could be overvalued, carrying idiosyncratic risks, which is fairly illiquid? Okay, that's a fairly loaded question. Someone is negative towards investing in property. Okay, so what is overvalued? If you buy a property and you haven't done your own research or got independent clarification on what the current market value is, yes, you can overbuy in a market. The property market is probably one of the more stable markets with a better trend than any other one I can think of, especially in London. Of course, the late 80s, 2007, 6, 7, and currently with Brexit, central London is suffering massively. But as a general trend, you know, I spoke to a lady that bought in 1982 and she bought a house for £12,000 and I just valued it for 1.1 million. So I don't think she would be so worried about whether she overpaid at that point or not. But yes, you do always run the risk of overpaying for property because it's a complete free market. I've had people overpay for properties. I've had people buy for way under market value as well. The main thing is to be smart, to do your research, to not get carried away and think heavily with your heart. Everyone does think with their heart to a certain degree. You know, it's only psychopaths that can switch that off, I believe. And hopefully none of my listeners are, and if they are, I'm sorry. Please forgive me for making that comment. Why would you, okay, and there are idiosyncratic risks in property. Every property is different. You could buy a property in a floodplain and you could have serious issues with subsidence. You could buy a property in a large tower block and a large tower block could go up next to it, blocking out your natural sunlight, and there's nothing you can do about it. There are always those risks, but there are always those risks with pretty much everything that you're going to buy. If you're going to buy shares in Apple, you're going to think that's a pretty safe investment. If you're going to buy shares in Bitcoin, you're going to think that's a safe investment until something goes wrong. There are always going to be those risks. Property is proven to be more stable, more secure than well, pretty much any other investment I can think of, and there might be some commodities that are safer, but I can't think of them right now and not yielding the same returns that London-based property investment has done over the past maybe 30 years. But Dean makes a very good point. Property is fairly illiquid. When you're comparing property to stocks, to Bitcoin, again, I don't know why I'm saying Bitcoin, I hope you're not investing in that right now. It is an illiquid asset. It can take months to sell a property. If you're willing to sell for less than the market value, you can sell in less than a day. There are ways of selling extremely quickly if you really need to, but generally speaking, it can take months to get out of your investment. I guess you've got to think about how fast the property market changes. Even with the property market in the 80s, it wasn't seen as a cliff edge. It wasn't like when the stock market crashed, it happened in a day and then carried on. Huge changes happen in a day. It can take time. With Brexit, there was an initial shock, maybe 5% around here, and then a gradual decline, slight months of increased activity and then decreases. But maybe it doesn't move as quickly as other markets do. from my experience, it doesn't anyway. We tend to get months of stability and then a change, which can take a few months, and then months of stability, then another change. So the illiquid side of selling a property is something that you definitely need to think about, but not something that is such an issue as if a stock moves very quickly downwards and takes months to sell. You can always trade in and trade out, but you're not going to see the same movements in the property market as you will in the stock market, traditionally speaking. Obviously something crazy could happen and I could be completely wrong, but as things stand, that's how we are. What would happen to house prices if interest rates normalised and banks reduce lending? Normalised is a tricky one because I think in the 80s, 90s, people were having interest rates of around 10%. When I first bought a property about 8 years ago, my first purchase was about 5%. We're now at 2%. If I was to buy again my first property, it's probably gone up a bit in value. Not so much so that if the interest rates were the same again, I wouldn't buy the property. But if I was to buy it now, obviously the interest rates being like 2% for a good mortgage, it's obviously a lot easier to buy. I think it depends on where you're buying. So if you're in a area where people are leveraged heavily, so people have 10% deposits, 15% deposits, I think a large increase in interest rates quickly will have a big issue in those locations. Central London is not going to be affected. Most of my clients have 50% deposits, approximately 30 to 50 is definitely the rough average. They're not going to be so affected by a change, and their incomes tend to be quite in excess of their affordability. So I don't think around here will be such an issue, but in more, I'm not going to say impoverished areas, but areas where people are leveraged higher, that will have an effect. I think that's why London is also seen as a safer bet, because people aren't as leveraged as heavily, and so prices tend to be quite stable for that reason. So I guess it really depends on where you're buying as to whether that's going to be a large issue. It's going to be an issue in a lot of locations if interest rates jump up. By jump, I mean 2 or 3%. I can't see that happening. Mark Carney's very, very conservative with his changes and hasn't indicated that any large jumps. So I can't see it being an issue. If it was to happen and we were talking about 2 or 3%, then I would say that a lot of people in areas that are highly leveraged with 10% deposits, that are working families where both partners are working, that would see a lot of people needing to sell quite quickly, which will bring prices down. However, it does depend completely on the location you're buying in. We have our own problems here in Clapham, and they're not really related to interest rates. I mean, maybe 30% of our buyers are cash buyers, which seems absolutely bizarre because mortgages are so cheap at the moment. I don't know why you wouldn't get a mortgage. I mean, 2% mortgage, I think my last mortgage was 2%. That's just insane. And we fixed at that price as well. So even if there is an interest rate rise, it's not going anywhere for the next 3 years. So it's a very tricky question to answer, but it does depend on where you are as to whether it's going to be a large issue and how much it's going to affect the market around you. So there's my broad strokes look at buy-to-let investing. We went into more detail about specific points there at the end, and some real broad strokes at the beginning. But if you've got any specific questions, anything you'd like me to answer for you, please do drop us a message either on my page, which is Patrick Henry Property, or my company's page, Patrick Henry London. Be very happy to answer your questions. And if you want to know anything about my buy-to-let investment history, you're more than welcome to ask questions. I'll either answer them or be very cagey with my answers. Either way, thank you very much for listening. Hope you're all having a good day, taking care of yourselves, and making a wise move.